Not to kind of take too much time about me, because I really want to make this about you guys and some of the, financial literacy, tips and tricks that we know. But, super quick, this series is called Wealth Steps, right? So we're going to talk about what these 4 key steps are over the next 4 weeks, actually. We're going to go through a high overview today, but generally speaking, what these wealth steps are. And then we're going to talk about some specifics over the next few weeks. And then we're going to end the last week of the series is my favorite. We're going to actually talk about what we call cash flow mapping. We're going to give everyone a budget worksheet to kind of give you some tangible practice on how to really manage your cash flow. So, I have the chat box open. So as we go along, if anyone has any questions on topic, off topic, feel free to throw them in there. We'll probably run about 45 to 55 minutes of content. So super glad to be here. But again, like Miguel said, I work for Alliance Advisory Group. We're a firm out of Western New York, Buffalo, Rochester, Jamestown, Syracuse. And, really part of the, my mission is really to kind of give back from that financial literacy standpoint. I think, it's something that most people aren't taught. Now, this is really the exception to the rule. And I'm so glad to be here. But typically in colleges or even any sort of academic setting, there really isn't too much, education that's being put out behind it. So, with that, we'll kind of jump right in and we'll talk about, again, what is this series going to cover? So again, the first 3 weeks, it's going to be specifically on wealth steps. And then that last week, we're going to talk about some budgeting practices. And really, we're going to give clarity around what we should be doing from an order of operations standpoint, right? There's a lot of times of things that we know maybe we should be doing from a financial standpoint, but sometimes it's like, what do we do first, second, or third? And there's really an order of operations, right? I put my socks on first today, then my shoes, not the other way around. And it sounds silly, but it really matters how we do things. And this week we're just gonna review all those steps in general, and then we'll kind of dive down in the next couple of weeks. So wealth steps, what is it? It's really all about your money, right? And so my goal is to give us clarity around our money, right? How do we budget effectively? What are the small decisions that we can make now, whether it's early in your career or whether it's midway through? It's never too early to kind of make those improvements. And we're going to talk about how to protect your cash flow. And so wealth steps really is it's a 4-step process. And I recognize that money can be confusing or overwhelming at times. But my hope is that after we go through this wealth step series, is that I can provide you guys with some more clarity, some confidence, and really just have more awareness around your money. It really is kind of that stressor of what do we do first, and I jokingly call it adulting, right? There's lots of things that we know that we're maybe supposed to do, and many people tend to get advice, from Google, the internet, social media, family, and some of that may be great, and there's definitely appropriate, but I'd like to kind of share some of the uncommon practices that we kind of believe in. So, when we talk about the stability, this confidence and clarity, I've told Miguel a couple of times, I'm kind of in the peace of mind business, right? Because when you think about money, there's products all over the place. You can go to a bank, open up savings accounts, credit cards, insurances, investments. It can get overwhelming. And really all of those products are just tools, right? Tools are used to accomplish a goal, but you really need to have some expertise to use the tools, I would say. If you put me under the hood of a car or gave me a tile saw, it wouldn't work out pretty well. I wouldn't know what I was doing. I'd have to go to kind of an expert and learn. So, I really tell people I'm more like a cash flow coach or more like a therapist than a financial planner. But really today, keeping it high level, it's just that, people who have gone through this wealth steps process before have said that they felt that stability, that confidence, and that clarity. And really, it's about achieving financial balance. You'll hear me talk about balance a lot. And I think from a balance standpoint, we really kind of break these steps down into 4 categories. So the first step is income protection. Right? How do we protect our wealth? How do we protect our wealth building potential? Secondly, we're going to talk about cash flow and savings, right? What does it mean to be a world-class saver? How much should you be saving? Then we're going to talk about balance and liquidity. Like, where do we save our money? Oftentimes people just either save in the bank account or in their retirement. Both are super important, but there's a lot of other places that we should know about where we can save. Then lastly, we'll talk about debt management, right? There's good debt and bad debt. What's the strategy behind it? So, that's the wealth steps, curriculum. And we talk about, why it's important. So, from an importance standpoint, let's talk about what we're actually focusing on. And that's your wealth building potential, right? Now, I truly believe that, the earlier we start to plan for the future, the more time that our money and these habits, good habits, have to work. I think that, even the smallest amount of savings impact today, savings changes today will have big impacts. If you think about, hundreds of years ago when you had the wooden ships, right? If a ship was crossing the ocean and they were 2 or 3 degrees off course, they could land in a very different place than where they thought they were going. And I find that analogy to be true with us today, right? Whether we make small incremental saving changes today, debt pay down strategies today, over time, it really compounds. So that's my hope. Again, today it's going to be high level, but we're going to look at an example, right? And this is kind of a husband and wife, a couple that we'll see a couple times throughout Wealth Steps. But let's take a look. So we have a couple here, their average age, they're 40, 38 years old. They have 25 years left till they retire. And collectively, they make $120,000. So each spouse maybe makes 60 grand. Now, this is an example we're going to talk about. And I know that maybe they may be a little bit older than, some of us in the room, but actually the younger you are, the more this example actually makes sense. So it actually only enhances the conversation. So this couple, they're bringing in $120,000 a year, today, and that income is really what fuels their lifestyle, right? It fuels their lifestyle. It has to be used to build a future for tomorrow. It really is everything, right? Outside of their nest egg. So we look at this couple, they make 120,000, and let's say they get an average, raise about 4% every year. It's kind of standard if you, stay at a job over time. Let's take a look at what happens. So, this household, this family, the Joneses, we'll call them, the household income increases 4% every year, which means in 25 years, there's actually $5 million coming into their balance sheet. That's the money that's accumulating just from work. We're not making investments, just working and compounding. So if you think about it, how much of that $5 million fuels their life along the way, and how much of it is actually being set aside for tomorrow, including retirement? The average 23-year-old making 50 grand a year, getting an annual raise of about 4%, will have about $5.2 million by the time they get to retirement. So it's a lot of cash if you think about it's going to pass through our bank accounts. So, what I see typically oftentimes is people, maybe making an income, and it's not really about how much you make, because you can be making $600,000 a year, but be spending $601,000 and you're negative, right? So it's less about the amount you make and more kind of about the balance and the percentage. Now, obviously, this couple who's saving 100% of their income isn't realistic, right? You can never save all of your money. That'd be crazy, right? So let's kind of look at kind of a more real example here. So this couple, they were to have an annual savings rate of only 5%. So let me maybe ask, and we can kind of put it in the chat. I guess I would ask everyone, if you had to guess, what do you think the average American saves, like on an annual basis of their income? If you had to put a percent to it, what would you say the average American saves? Curious to kind of hear some feedback. From all different sources of income. It could be retirement, it could be cash, and we're just looking kind of for a percent amount. Let's take a look here. And obviously we know that, during, COVID, a lot of things have been closed. So, actually savings have gone up a little bit because people can't spend their money. So I see 15% coming in. Yeah, I would, let you know, maybe it's surprising, but typically the average American only saves about 6.5% of their income. The rest of it is going to lifestyle, taxes, debt. During COVID, the savings rate actually spiked up to about 32%. But again, that's because nobody could spend their money. But I have reason to believe that it's probably going to go back to normal once things start opening up again. It's like that person who wins the lotto and you hear that they're broke in 2 or 3 years because they had bad money habits to begin with. So this couple is kind of average, right? They're making 120 grand. They're getting an annual raise of about 4%, but they're only saving 5% of their money. When they get to retirement age, they're going to have only $250,000 left to deploy. So if you think about it, that $250,000 a year, when you get closer to retirement, it's only about $12,000 a year from like a salary standpoint. Like if you break that down and stretch it out. People are living longer these days, right? So it's important to figure out how do we stretch this income for 10, 15, 20, 25 years. So really, we're gonna put this couple on hold. We're gonna circle back to them a couple times, but I would say that it's safe to assume that only saving 5% of your income is not enough, right? So we're gonna circle back on that in a little bit. I want to talk about us. Right? I meeting all you for the first time, but I think generally speaking, people have common goals. Right? What are some of those common goals? Right? To buy a house, right? Start a family, maybe take the travel, trip of your dreams, retire on your own terms, land that dream job, right? All of these things are common goals that we have. And usually it's not about money, right? Usually it's not, I want to have $1 million in my bank account. Yeah, that'd be great. But goals are the lifestyle decisions that we have, and money is the tool to help accomplish them. So I think it's really important to identify how to accomplish these goals and really what could, put them at risk. So, even though we may have been taught to take risk, you may hear on the news, it's good to, invest and take risk, and maybe that's the best thing that we should do. I would say, generally speaking, people aren't risk takers. Generally speaking, right? They would typically prefer to have financial stability, to have confidence, and to have clarity. Maybe I'm wrong, but I think that, I know at least for me, if I could have the security, confidence, and clarity without the risk that can make me, nauseous at night, I would take it any day of the week. So sure, yes, you always take some calculated risk, and that's okay, especially in our early years, right? The longer we have to kind of accumulate wealth, the more risk or so that we can take. But at the end of the day, what most people are seeking is this confidence, this clarity, and this stability. The reality is that there are some things that get in the way, right? Life happens, nothing ever goes according to plan. It's important to readjust and reassess these plans, but typically what gets in the way of that financial stability or confidence kind of looks something like this, right? It's starting to be this, we've heard of these terms before, and we're starting to think, hey, maybe I should focus on this. There's a swirling fog of financial priorities, which begins to grow. We go to school, we go to work, we start careers, we have relationships and families. These are things that fill up our time, fill up our life all along the way. And, we get bombarded with a lot of opinions and noise that's out there, right? What should we do with their money? What shouldn't we do with their money? If you, after this, meeting, if you go on Google and search, is a 401k good? Is a 401k bad? You're going to get 10 answers that say yes to each of them. So it's confusing, and everyone has an opinion out there. And, a lot of the ideas, that worked a generation ago, worked even in the 80s and 90s, I don't think really work anymore. This generation, we've been really hit with a triple whammy of high cost of living, student loans, stagnant wages, um, you know, Amazon at your fingertips to grab our money. My wife thinks Jeff Bezos started COVID to have more people shop at Amazon. I don't think that's true, but she's onto something a little bit. But the reality is that a lot of these, questions start to build, right? Many of these things are terms that we've thought, or things that, we know we should think about someday in the future, but they just keep on coming, only to bring more stress and cloudiness, and they just keep on building. I think that it's really unfair to really think that people can do it on their own. It's something that, again, that's typically not taught in schools growing up, which again is why I'm so grateful to be here. But again, there's a lot of noise that's out there these days. You have people on social media, on Instagram, on TikTok, trying to say that they're money or stock experts. And yeah, some of their advice may be all right, but a lot of times they're just trying to get likes or trying to get views. And that's okay, I guess. But when you think about a lot of the questions that we have, it's hey, do I need a retirement account? What kind of retirement account? What do I do with my taxes? Do I need life insurance? How do I manage my student loan debt? Do I need a financial planner? How do I budget? Right? These are certainly isn't the all-inclusive list, but it's a lot of things that that I think resonate, even for myself before I kind of came into the industry. So really, how do we manage reality, right? We have all this clutter, this noise that's in the future. But here we are today, April 6, 2021. And no matter where you are in your life, no matter what age you're at, or no matter how much experience you have, or what you've done financially or hope to do, really, I kind of view this as the starting point, right? Whether it's just getting ready to start your career or changing careers or whatever it may be. And, there are a lot of these financial choices and sound bites that we hear all the time. They can be super distracting and overwhelming. That's why I love podcasts in general, because you get to hear a full thought instead of just, a 30-second news blurb. But really what we're, saying and teaching here is, this is when we start to look at your financial future. So what should the first step be? So we would say the first step in Wealth Steps is to address protection. I would say, and I'm not sure if anyone would agree or disagree, but I would say that the future is uncertain, right? If 2020 taught us anything, it's that, there's a lot of uncertainty that's out there. I personally have a 0% chance of retiring tomorrow. Maybe someone's different, but I'm not going to retire tomorrow. But there's a greater than 0% chance that something could happen that can disrupt my family or disrupt my savings. It could be a car accident, it could be a sickness, and sure, those percentages are probably pretty low, but they're greater than zero. So really, from a protection standpoint, the first thing that we want to talk about is let's understand those employee benefits when you're, switching jobs or starting a new job in the career field, right? Oftentimes, employers will give you a packet full of papers or a PDF and say, go ahead and pick your benefits. There's not a lot of education behind it. So, protection, understanding your employee benefits, understanding your car insurance options. You can shop for those, and you want to have the right amount of limits. Understanding life insurances, right? How do we get these in place when we're young and when we're healthy? Because typically for those type of things, people want it later in life, and it can be more difficult, if not even possible, to grab. Looking at income protection, right? If you're working and you're, unfortunate, let's say, if I were to get sick and I couldn't work for 2.5 years, how would my mortgage, utilities, and groceries get paid? Right? So we can talk about the future all day, and the future is important. But if we don't protect today, it really puts the future at risk. So that's step one. Step two is becoming a world-class saver, right? And so What is a world-class saver? It's when someone saves 15 to 20% of their income, right? So instead of focusing on just the rate of return or the stock market, let's focus on the only thing you can control. That's your savings rate. Right now, we certainly believe, the stock market's important. It's a key part of our retirement, but we can't control that. The one thing that I can control is how much I save on a monthly basis. And maybe you're at 6% now, but we'll slowly kind of get you there. And I would say that the amount that you save is much more important than any rate of return you're trying to get. And so, we're going to cover all of them today, but next week, we're going to cover these first two steps in more detail: protection and world-class savings. The third step is having a life event funds. You may have heard the term emergency fund before. I think that's kind of negative because it's implying something bad that's happening, but what about if we call it a life event fund? We have money that's accessible to go on vacation, to invest in that friend's business, to have that wedding, right? Because we want our money in accessible places. It's good to have your money in the bank, really low interest rates, but it's there. It's good to have your money in a 401k or retirement account because it grows over time, but you can't really touch it. So where else can we put our money? And we'll certainly talk about it. And step 4 is living debt free. And a lot of times, sometimes I get some head scratches here and they say, really, is that step 4? It doesn't mean we ignore your debt, but it's about kind of being thoughtful with debt, right? So end goal, we're living a life that's debt free. We have no reoccurring credit card balances. We have no student loan payments. We live in a house that's the right size for you. And we recognize it takes time, right? If I have a fitness goal and go to the gym, I'm not going to accomplish that goal tomorrow, right? It takes time. And that's the same thing with wealth steps. It's really something we do throughout our life. When we come to a debt standpoint, what we don't want to see sometimes is people that are just really super focused on their debt and they put everything else aside, right? If you're double paying your student loans because you want to get rid of them, but you have no cash built up for emergency or life events, you're not saving money and there's no protection in place, it can create kind of this hamster wheel of building up money, paying off your debt, having no savings, something happens in life and you go back into debt. And it's like this vicious treadmill of a cycle. So, again, we'll cover basics today, but the third week we'll be covering these two steps together. And really those 4 are financial balance. So we're going to talk about these, but just imagine for a second how all these work together, right? Imagine that we have the perfect insurances and protection in place. Imagine you're saving 10, 15, 20% of what you make every year. You have ample levels of liquidity. You have access to your money. You've eliminated the bad debt that's in your lifestyle, no longer facing the high interest rates of the Best Buy credit cards or whatnot. And again, it all takes time, but ultimately it leads to this stability, this confidence and clarity. And it's important not to put too many eggs in one basket, but have this balanced approach to your financial future. And so again, before we kind of cover these in a high level, is step 1 is protecting your todays. Becoming the world-class saver, step 2. That'll be next week. Then we'll do life event funds and living debt-free the following week. And then at the end of the series, we're going to talk more about specific tips to what we call cash flow mapping and why that's different than traditional budgeting. So let's jump into some tangible stuff we can take home. So step 1, protecting your todays. Again, there's a correct way to get dressed every morning, right? You do it in order, and there's a correct way to get dressed financially. Again, socks then shoes, there's an order to it. And so many times people worry about the future 20, 30, 40 years down the road, but they forget about tomorrow. So let's look at some of these threats. Really, all of these are not pleasant, right? I wouldn't wish any of these on anyone. A loss of home would be, traumatizing, right? If there's a fire or something, getting hospitalized or sick, right, due to an injury or an illness, having a permanent loss of income, having a car that's stolen or totaled, or maybe getting sued for something and you don't have the right kind of limits, right? So as you guys are kind of looking at this, maybe kind of think, what would be the biggest threat that would happen, right? They all would not be pleasant, and they're all not tied for first. So as you're kind of thinking it through, I would kind of say that I think the biggest threat would always be this permanent loss of income, right? If you lose the ability to work forever, it's going to change all of your goals. It's going to change your debt situation. That permanent loss of income in every household, I think, is without a doubt the biggest threat that all individuals and families face. So why do I believe that? Well, I think the most valuable asset you own is you. It's not the car, not the house, not the bank account balance. It's you and your ability to earn money. So remember that couple? It's a case study where they're making 120 grand over the next 25 years. We want to kind of look at this as a case study as to what can happen from a protection standpoint. So let's look at that protection, right? Going through wealth steps, we're going to teach you guys kind of in detail, how do we put policies and education and decisions in place before something bad happens, right? The person who wants car insurance after the accident probably is a little different opinion. He'll pay whatever he has to pay to get it replaced versus the guy before. So, if your income stops, if your car is stolen, if these things happen, you don't want to have to take money out of your bank account to replace these things. You want insurance in place to protect them. So the question then becomes, okay, Frank, how much insurance makes sense? And it really has nothing to do with kind of the need, right? Because we typically do need it. It sounds kind of silly, but I'll ask this question rhetorically. I'll say, we all have car insurance, right? If you drive, you have to, right? I guess, what do you want your car insurance to do if your car was stolen or destroyed totally today? You probably want the insurance to replace your car, right? Well, how much of the car? Just the front? Just the end? Just the steering wheel? Maybe you want a car that's 20 years old? No, I mean, if your insurance company only gave you half of a car or a car that's 30 years old, you probably wouldn't be a happy camper, right? We all want to fully replace the car. We want to fully replace the house. We want to fully replace that jewelry that you get insurance on. And we want the same, I think, when it comes to these life values, right? The income that we're going to be earning. Because we agree that there's never a point in time in your life when you're better off kind of doing it on your own, right? So you have to kind of plan for these. And we'll talk again in detail next week, but generally speaking, it's important to look at all of these. And I always pose this question, what if insurance has had no cost? That'd be cool, right? I think the moment that, I shop for car insurance or homeowners insurance, the first thing I think about is what's the cost, right? But what if insurance had no cost to you? Like, how much would you have, right? Like if your employer came to you tomorrow and said, Frank, you can have an additional $500,000 of life insurance as part of your company plan. It doesn't cost you anything. Do you want it? Duh, of course I'd say yeah. Yeah, I'm in, I'll take it. And I think that's true when it comes to all type of protection, right? I think that it's more about a cost conversation instead of like, do I need it or do I want it? So what we kind of do through the Wealth Steps program is kind of coach and give awareness around how do we kind of pay for that? How do we get past that cost hurdle? Right? How do we increase our protection? It's really about adjusting our cash flow to avoid these out-of-pocket costs, right? So there are ways in which you can help improve and address that issue, right? So when we look at some of these options, right, we look at future earnings that come in. We look at how do we redeploy annual savings, right? Examining lifestyle, right? I'm never going to be someone to tell you what you can and can't spend your money on, but let's have an awareness conversation around it. How do we shop for some of these things, right? How do we reduce those costs? So that's, kind of a teaser for next week, at least on the protection side. But, again, I encourage anyone, if you have any, comments or questions throughout, feel free to throw it in the chat and, I'll kind of address it. But from a high level, that's really what we address from a protection standpoint. Secondly, becoming a world-class saver, right? Building a more successful financial future really begins with becoming a world-class saver. So let's talk about that, right? When I talk about the real cost of living, what that typically talks about is this concept of inflation, right? Maybe you've heard about it before or had a class on it. And the idea is that over time, our spending power changes, right? Milk, stamps, gasoline, furniture, automobiles, homes are going to cost more down the road, right, than it does today. I think most people have a good understanding of inflation, but there's another challenge to it. That's taxes, right? I think, politics aside, we're going to stay neutral, but I will say that, we have 30 some odd trillion dollars of debt. We've had increasing debt for the last 20 some odd years. At some point, taxes are probably going to have to go up in one way or another, right? We recognize that inflation changes over time. We recognize that taxes are probably going to have to go up. So all of those are things that eat into our savings potential, our savings amount, right? The higher the taxes, the more difficult it is to build wealth. So, we also must take into account new inventions, product wear and tear. There's so many things grabbing at our savings, right? We try to save, but the new iPhone comes out. We try to save and the PS6 comes out, right? Whatever the next, thing is going to be. There's all these new inventions. There's improving a living standard, right? So we recognize that there are all these things trying to grab at our cash flow. And it's really important to put a process in place to become a better saver. Got to kind of question the chat, at what age should one consider long-term health insurance? And, when it comes to things like health insurance, benefits, my kind of opinion is it's always good to start looking the younger and healthier we are. Typically I guess there's two things. There's health insurances, like for medical coverage, and then there's like long-term care coverage and life insurances down the road. Really, from kind of that long-term standpoint, the younger and healthier we are today, it's more ideal to look now than later because we can't guarantee the future. There's a couple different strategies you can look at long-term coverage. It's expensive. If anyone's ever had to deal with putting a family member through, kind of like an assisted living home or whatnot, it can be, $10, $12, $13,000 a month. So, there are certain things that we can do in place today to help prepare for that from an insurance standpoint. So absolutely can take those conversations, one-on-one, but I always think from a protection standpoint, the ideal time is really, today, because we can't guarantee what tomorrow, next week, next month, next year would look like. But thanks for the question, Lindsay. And so really, when we talk about, the world-class savings, these things that we're buying next year didn't exist in the past. There's new inventions coming out. There's all these things that are eating up cash on our balance sheet. So really, how do we do that? Kind of, again, tying back into this couple, let's talk about the power of savings. The same couple, same income, same $5 million that they're going to have coming into their financial picture. And let's say that they're, getting that 4% raise every single year and they're saving all their money, but they're getting a 5% rate of return. Well, they'd have about $9 million when they get ready to retire. And that's assuming that they invested 100% of their income, which we know is impossible, right? So let's look at a more realistic scenario. So again, they're saving this, this couple now is still only saving 5% of their income. And their 5% savings is, we're going to say, getting 5% rate of return. Try to be conservative. Obviously, some years go up or down. But if they're saving 5% of their income and only getting a 5% rate of return, they're going to have about $453,000 for retirement. It's not a lot when you think about it. Now, if we kind of project out and say, hey, the example from an optimal saving standpoint is really getting people to be that 15 to 20%. And we're going to show you and kind of cover specific steps next week and the last week about how do we improve our savings? How do we start making small growth? Because if we can get 1% better tomorrow than we are today, that's all that matters. Someone's not going to go from 4% to 20% overnight. If you do, let me know what the trick is, right? It typically doesn't happen. But it's about making incremental growth. And so this same couple, again, 5% rate of return on their 5% savings. So now let's take a look at what an optimal saver would look like without increasing their investments. So they're still getting the same 5%. They don't have to be super risky. They don't have to get 30% on their investments. They're still getting 5%, but now they're saving 20% of their income. It's almost 5 times the amount of wealth that's sticking with them for the future without adding additional risk, right? A lot of times people say, hey, to get you to that retirement number, you got to be risky in the stock market. Okay, maybe, if I were to say, Miguel, if we can get you 15% in the market every year, you'll be fine. Well, yeah, that math probably works out, but you can't guarantee that. And I wouldn't build a plan on that. So taking the 5% rate of return, but now they're saving at an optimal level. So much more wealth has stayed on their balance sheet. But let's take a look at some of the obstacles that can exist, right? We recognize that overspending is a big one, especially in the age of Amazon and Google Pay, saving things on my phone. It's dangerous. People living in homes that's too big that they can afford. New cars, debt, technology, keeping up with the Joneses. Again, meaning I got to have the newest invention, the newest, video game console, the flashiest, clothing. Again, we're not telling people to live without, but there is just having some awareness around it. So from a world-class savings standpoint, we'll dive deep next week into kind of the differences between the two. These are obstacles that we just need to have awareness. And the last thing I'll say about savings is typically people confuse their savings, meaning we think it's only a bank account. The bank account is really short-term savings. You're probably going to spend that money at some point, right? We're probably going to spend it on a house or a vacation or a car. But this type of savings is really meant for retirement, money that's going to replace our paycheck later down the road. So again, we'll dive deeper into that, but kind of staying high level within our timetable here is step 3 is a life event funds. So imagine what's happening. You've put the protection in place. You're routinely saving 15 to 20% of your income. We're not hoping that we're going to get bailed out by the stock market. Right? So now that we're saving money, the question is, where else should I be saving? So if you look at this concept of liquidity, when I say liquidity, what that basically means is access to your money, right? If you have all your money in gold bars buried in the backyard, you can't really spend it pretty easily. So if you kind of look, and you guys, as I'm kind of talking through this, maybe kind of think to yourself, what's the most liquid and what's the least liquid? So these are some common places that people can store wealth. 401k, cash value life insurance, real estate equity, bank accounts, mutual funds. They all serve a purpose, but they all have different levels of how do I access that money? So here's the correct order, and let's see if that kind of surprises or confirms any thoughts. Bank accounts, super liquid. We all know that we can access it. And we have cash value life insurance, right? You have life insurance that's meant to pay a death benefit, but you can also use it as a liquid retirement account. You have mutual funds, right? A little less liquid. There may be time constraints on it. There may be some fees. 401k, you can't really touch it unless there's a qualifying reason or you're 59 and a half. Real estate equity, typically it takes time to build up value in a house. So this goes back to the theme of balance. We want to have balance where we're saving. Why? Because life happens, right? Things are unpredictable, and it could be good and bad. This slide or this presentation was made pre-COVID. You think about loss of job, you think about natural disasters, how much more true is that today, right? I mean, I know people even personally have been affected by just life that happened. And typically people would say, let's have 3 months of, bills kind of put aside. It's actually closer to 9 months, right? That's the typical guideline, and, even a little bit longer in some cases. But life events happen, loss of a job, investment opportunities, weddings. We talked about long-term, health insurance, parent care, education. These are all things that require liquidity. If all of your money was kind of stuck in a 401k, yeah, you could access it, but you'd pay fees and you'd pay taxes on it. So I recognize that when we do these seminars, a lot of us are just starting our career journey. We're just starting the phase of our life to accumulate assets, right? So most young professionals just haven't had the time to build those assets. But I think it's still important to know, what does it mean to be liquid versus not liquid? So again, this same couple, they make collectively $120,000 a year, but they only have $20,000 in the bank. That's the only place where they have their money. So we would consider them what we call illiquid, meaning they don't have a lot of their money accessible. The rest of it can be in the house, retirement account, maybe gold or whatnot, places where you can't easily spend it. So what does it mean to be optimal, right? So maybe this average, couple, this person is pretty illiquid. They don't have access to their money. They're not able to respond to sudden life event changes, right? They don't have the money accessible, and it can lead to debt or taxes or fees. So we'll talk about what does it mean to be an optimal from a liquidity standpoint. So again, for our sake, I would really more focus on the percent here versus the dollar amount, right? Because it's all relative to the income. But generally speaking, having 75% of our assets in a liquid type of account is ideal. And I think COVID really proved that, right? Because if you have access to liquid money for 9 months or so of a year, you're going to be in a better place. And again, I just want to say that dollar amount doesn't really make sense. It doesn't really matter here per se. It's the percentage, because everyone's, income is different and is going to be different. Right? So it takes time. But I think for us people, who are either starting off in our career or even just starting from an awareness point today, it's good to kind of have that in our mind to make those slow changes. And again, not this week, but the next week, we're going to be talking about these last two steps, liquidity and debt. So you may be thinking, okay, Frank, I understand that makes sense kind of from a goal standpoint, but how long would that really take? Would it take me a long time to become optimal, go from red to green? So in this example, this couple, needs $70,000 of liquid assets, right? That's to get them to the optimal category. Again, we're assuming that they've become world-class savers through coaching and awareness, right? They're now saving $24,000 a year from tweaking where they save and how they understand cash flow, which is my favorite part of the series on the last week. So really, it'll take them a little more than 3 years, right? It's that incremental change. It's not going to happen overnight, but from putting the steps in place, it allows us to build wealth. Step 4, living debt-free. Right? It's something that our society is hyper aware of, right? You can turn on the news or radio and you're going to hear people talking about, one quote I heard one time someone say is, if you have any debt, the only way you should step inside of a restaurant is if you're working there. How crazy is that, right? I mean, I want to still live my life. And I think that there's this hyper sensitivity around debt, but we're going to talk about the different types of debt. Right? Which ones do we focus on paying off first? How do we pay off our debt without jeopardizing our savings, without jeopardizing our protection, and without jeopardizing our liquidity. But again, really from a debt standpoint, there's really two main things that we see that really get people in trouble. The first is a mortgage. So there may be current homeowners here or people getting ready to buy in the first time home buyer space. It's crazy out there right now. Can't really predict the future. I know people who are trying to time it and wait, but it keeps going up. But what I will say from a mortgage standpoint, it's important to know what percent of your income should you put into a mortgage? 30%, 40%? We'll talk about it, what the right kind of guidelines are. I think more importantly is this short-term debt, right? Has anyone gone to Kohl's or Target or Best Buy or any store and they say you can save 5% with this credit card? I mean, that happens all the time. And I'm not saying store credit cards are always bad, but if they're not used properly, a lot of those balances are pretty high and they can get pretty nasty. So we'll talk about what's good debt, what's bad debt, and how do we want to focus on it, right? So we're not stuck in that debt hamster wheel forever. When you think about debt, take a look at this. Let's say, we're building wealth, we're saving money, we're saving 8% of our wealth, and we got some good momentum, but we have 18% in credit card interest rates or personal loan interest rates. You're positive 8%, but 18 is leaking outside, the back. You're really negative 10%, right? A lot of times there isn't an awareness around the debt on the back end. In a previous life, I was actually a branch manager at a bank. Loved my time there. Wasn't ultimately what I was passionate about, but one of the things that I helped a lot of people with was refinancing that debt and understanding, when does it make sense to go refinance debt and get that inquiry on our credit? When does it not make sense? Right. So again, we'll talk about them all in detail, but sometimes it's like one step forward, 2 or 3 steps back. So with 12 steps on the debt, we're going to talk about how do we eliminate the bad debt? How do we start to make progress to be debt free? One example, there's 2 examples we talked about, and one is car ownership. I am not saying sell your car and don't travel, but let's just kind of talk through it for a second. Car ownership typically can cost a household upwards of $1 million throughout their life. If you think about all the payments, all the insurance, all the premium, the driveway that gets replaced, these automobiles go down in value the second you drive them off the lot. Am I saying that you have to buy only used cars? No, right? But it's just having some awareness around it, right? I think, personally for me, when my looking for a car, right, try to find a good used car instead of buying that new one. And it doesn't have to be that forever, right? I have dreams of cars that I want to own someday, but I'm at the place in my life where I need to kind of stay within kind of those boundaries, right, to achieve that. The other example is mortgages, right? So as we're starting to enter the home buying process for any new people here, getting ready to graduate and start thinking about it, there's this what we call crowding out effect that happens, right? The market is crazy right now. And when you look at what a mortgage company will approve someone for, they'll approve someone a loan for 30 to 35% of their income, right? So that leaves, not much left. That leaves, 70, 65% left to account for lifestyle, savings, taxes, the future. So, a general rule of thumb, and obviously every situation is unique, but generally, having a mortgage payment that's about 15% of your income is really ideal, right? At least from a first-time home buyer standpoint. It allows you to build equity. It allows you to buy the furniture, right? Make the remodels, all the things that come with it. So, if we think about it, sometimes, this may not be a popular opinion, but sometimes the best decision may be to live with family or split rent with friends for a couple years until the savings is up, until the protection is there, until some of the bad debt is taken out. Our society typically teaches us go to college, buy a house, have a family, and work at the same job for 40 years. Doesn't happen anymore. So again, that's one of the things that we see from a debt standpoint. And thinking about opportunity gain, right? So we'll learn on the last session about how do we budget and how do we plan for our cash flow. So we're going to talk about how do we convert all of our short-term debt numbers into a monthly number, right? So say you have a monthly amount of your minimum payments. What if we just make the minimum payments for a year? That frees up extra cash flow that we can redeploy elsewhere, right? So Wealth Steps teaches us to put you and your family first and the credit card companies second, right? I'm not saying ignore them, but one strategy, I really like is, let's say you have some student loans. Minimum payment is $200. What if we're saving $500 a month for student loans? 200 is your minimum student loan payment. Then 300 a month stays in an extra savings account. Then at the end of the year, we make a one-time payment of $3,600 to the loan. All throughout the year, you had that money there in case of an emergency, right? If you overpay the student loan company and something unexpected happens, you can't call up Nelnet or Great Lakes and say, hey, I changed my mind. Can you give me some of that loan payment back? Like once you've paid it, it's gone. So we'll learn how do we have these debt strategies. What do you do if you could recapture some of that cash flow from debt refinance or debt strategies? We can make sure we have proper levels of protection. Step one, make sure we're saving enough money. Step two, and make sure we have enough money from a lifestyle standpoint, which is step three. From that, I guess to kind of wrap up that debt standpoint, lastly, I would just kind of, want to give you guys some tangible things because, debt is the most, not concerning, but the most thing people want to learn about. And so some very quick action items you guys to kind of take, away from today is, if you are a homeowner, look at refinancing. Interest rates are super low. Maybe downsizing, or maybe, making sure you have enough money built up for that down payment. If you have short-term debt, maybe we reduce your lifestyle spending for 6 months or 12 months until we get to ample levels of liquidity. Right? I'm not saying don't do anything fun for the rest of your life, but maybe it makes sense for 6 months to kind of tighten up that budget, which we'll talk about in week 4, establishing that cash flow budget. Consolidating credit cards, right? Looking at what we call balance transfers, right? If you have the opportunity to take 20% interest rate credit card and move it to a 0%, typically makes sense. So I know we're right here at our time, but I guess we just wanted to end today before we open up to any other questions, is that I would say a lot of this is uncommon knowledge, right? Where we're going to be protected. We're going to be a world-class saver. We're going to have high levels of liquidity without the drag of short-term debt. And really what this Wealth Steps, presentation is meant to do, and what I do every day for clients, is really to show people where they are, how to get them to optimal, and what should the first ingredient or step that we do to improve. And as we're talking through this, you may be thinking, my goodness, I'm in the red. I think a lot of the young professionals that I work with, which most of my people are young professionals, are in the red or yellow, but it's okay, right? It takes time to build. So, I wanted to make sure I made that point, clear. And just to kind of, finish up, the results of the Wealth Steps are seen here. We'll talk about how do we get maximum protection? How do we build savings, live up to life event funds, and building up or lowering our debt, right? We'll find ourselves in a better place. So, I guess you kind of ended here, at the hour. I'm super, thankful. Lots of gratitude for being here. I appreciate everyone. I think if we can slowly start to make incremental change, that's what matters. And again, next week is going to be protection and savings. The following week is going to be liquidity and debt. Then the last week is going to be a budget cash flow exercise that will give everyone a workbook, and you can kind of work on your own. So that's all I have. Very thankful. If anyone has any questions, feel free to either go into the chat or come off. I really appreciate it.
Thank you so much, Frank. That was extremely helpful, and thank you for being so thorough with. I know this is still high level, and so we're gonna get into the smaller concepts within the next sessions. But super helpful information. Thank you so much. If anybody has questions, Frank is sticking around for a few minutes. Feel free to use the chat as well, and then we'll be around for a little bit. But thank you so much, Frank. Again, this is happening every Tuesday from 12:30 at 12:30 every Tuesday for the rest of the month. So feel free to stop in. Same Zoom link every week. So
I'm putting my contact, phone number and email in the chat. If anyone, I know when we talk through these things, sometimes personal questions may come up. Always happy just to kind of help or answer. So that's my personal cell phone. You can shoot me a text with if you want your name and where you were, or email. Be happy to kind of connect. But very grateful, everyone. I appreciate it.